Welcome to the Stockout. I'm your host, Mike Baudendistel, head of Intermodal at Sonar. And bad news, Stockouters, Grace Sharkey is no longer with FreightWaves. So as of right now, this is a one-person show, but Grace did not leave without giving us one last very good article describing essentially her recommendations for what shippers should do to bulletproof their supply chains, and sort of looks like this is just kind of being the ultimate, sort of parting words as far as what shippers should do, and what this sort of amounts to is a lot of digital blocking and tackling. Grace talks in this article about how Russia, since the attack on Ukraine in early 2022, they got really good at hacking into logistics operations for military purposes, but unfortunately those techniques can be used outside of a military setting, and that leaves shippers' supply chains vulnerable, including potentially those who listen to the Stockout. Our target audience here is CPG and retail companies. And so what Grace recommends is essentially digital blocking and tackling, which would be things like moving beyond passwords to more sophisticated encryption methods, aggressively filtering email, updating software, those type of things that could potentially be overlooked by some small and mid-sized shippers. So would encourage everyone to do that, and would also encourage everyone to sign up for the Stockout newsletter in addition to other newsletters that we have at FreightWaves. You can do that at www.freightwaves.com/the Stockout, or just up at the top under newsletters. Check out the variety of newsletters there. Maybe Fraud Watch is no longer going to be written, or maybe someone else will take over Fraud Watch, but mine is the second one under Market Insights. But all those things I think you can pull out some very good insights from various writers who participate at FreightWaves. With that, I want to move on to a freight market update. And the first chart I'm going to show here is the spot rate. So this is what the ticker we call, for those that are Sonar users, the NTIL, which is index of spot rates with the fuel excluded. So most spot rates would include fuel. We're taking it out here to give sort of an apples to apples comparison. And what this shows, a white line, if you're not familiar with our charts, the white line is 2025. 2024 is in green. 2023 is in pink. And the rates are ahead of last year. They've gotten to be more sensitive. So this is a measure of spot activity. And these are some of the carriers that would be impacted by things like the road check week, more weighted towards the spot market. And you see it jump higher than it did in the previous 2 years. Right now it's about $1.75 when you exclude fuel. And that is higher than what we've seen the past couple of years, and that sort of suggests that there's been some capacity that's come out of the marketplace. I want to go to the next one, which addresses the contract market, which is the outbound tender rejection rate, and that shows a similar pattern. When we look at the outbound tender rejection rate this year versus last year, this is a chart of relative capacity. And right now on the contract market, carriers are rejecting about 6.2% of tenders. There you see in the white line is the current year. That's up from last year about 4.3%, and up from 2 years ago about 3%. One of the first things you see when you log into Sonar is that the freight market is roughly in balance. I do write up an article every week that goes on GoSonar.com that you can find on GoSonar, and then resources, and then the PPI for Pricing Power Index, which is a qualitative assessment of whether shippers or carriers have more pricing power, sort of a scale from 0 to 100, 0 being shippers have all the pricing power, 100 being carriers having all the pricing power. I currently have it about 40, so slightly in favor of shippers, which is, I think, what is pretty consistent with a 6.2% tender rejection rate that has made a lot of progress from the perspective of carriers the past 2 years. I would note that this is fairly mixed by geography. If you look at just the biggest freight markets, Atlanta and Dallas currently have tender rejection rates of 8.8% and 7.4% respectively. On the other side of the large freight markets, Los Angeles and Harrisburg, more modest. Those are 4.2% and 3.9% tender rejection rates respectively. A lot of that has to do with trade flows. We've seen the LA market have a weak tender rejection rate of only a couple percent here in recent weeks. So that 4% is actually a pretty significant improvement. But on some of the East Coast port cities, we've seen a big spike in tender rejection rates at Savannah. Atlanta is downstream from Savannah, so that could be related to why Atlanta is higher than the national average. But there's been some tightness in the Savannah market, and a lot of that just has to do with trade flows, also on the West Coast, and these long haul lanes. Rail intermodal seems to have taken some share from truckload because the rail service levels have been pretty solid. And so all this is to say that this appears that there's been capacity that's come out of the market rather than any kind of increase in demand, which has caused those tender rejection rates to rise. In fact, the demand picture has been pretty lackluster. If we want to bring up the outbound tender volume index, so a tender is a request from a shipper to carrier submitted electronically to move a load. And here, see a different pattern than we saw in those capacity tender rejection rate chart and spot rate chart we just showed earlier. Here on the volume side of things, 2025 is that white line. It's about 10.5% below the green line, so about 10.5% down year over year. I think a lot of that is related to some of the interest rate sensitive sectors of the economy, things like construction or automotive, and also some consumer discontent as well. But kind of the main point here is that the tender rejection rate is about 200 basis points higher than it was last year, about 6% instead of about 4%, at the same time when tender volume is down about 10% year over year. So a tighter freight market on lower volume, and that really suggests that there's been a very significant amount of capacity that has come out of the market. And one way to illustrate that is the carrier details chart on the trucking authorities, which for those Sonar users, it's a ticker CDNCA.USA. And what this basically shows is that during COVID, the tight freight market, and then a really tremendous number of carriers came into the market. This is the change, net change in trucking authorities. So the number of trucking authorities that come into the industry, you subtract from that the number that exit, you have a net number. And really a tremendous number of new authorities came in during the pandemic in 2020, 2021, and even the first part of 2022, and really didn't stop until we really saw the substantial downturn in the freight market right around March or April of 2022. And then we've had this prolonged period of looseness in the freight market that's lasted now over 3 years. That's longer than you typically expect. We typically expect a trucking down cycle to be maybe 12 or 18 months. So we're more than double what you would typically expect. And throughout most of that time, the past 3 years, there's been carriers going out of the industry on a net basis. There was a little bit of a blip up in early 2025. That seems to have reversed itself there. And that latest data point is 173 carriers coming out of the market on a net basis. And so I think certainly all things considered, the last few years, a lot of capacity has come out of the marketplace. And sort of we look forward, there's usually some catalyst that gets the market going in one way or the other. I mean, one potential catalyst would be Trump administration tax cuts. There's been a lot of discussion of whether or not we're going to have tax cuts on those people that pay a lot of state and local taxes. So either who are in states with high income taxes, those would be states like California and New York, or states that have a lot of you have property taxes like Texas. You think Texas is being a low tax state because it has a 0% income tax, but it's actually seventh in terms of property taxes. So there's actually some people could benefit from that in quote unquote low income tax states as well, if they're able to deduct now 40,000 of SALT taxes instead of 10,000. One could be a pretty big impact for some people. Another catalyst that we've talked a lot about on FreightWaves.com is the potential for new driver requirements. So Trump administration issued new guidance to enforce stricter labor, CDL, and English language proficiency standards for truck drivers. This could potentially lead to a greater crunch in blue-collar labor. Drivers caught operating without the proper documentation or adequate English speaking comprehension could be placed out of service or potential deportation. And essentially, the Secretary of Transportation, Sean Duffy, reestablished lack of English proficiency as an out-of-service violation for commercial drivers. Here we have an article showing on the screen that Craig Fuller wrote on Monday, May 26th, and talking about how There's been an overcapacity situation that has largely been shaped, has shaped the industry largely because of some trucking carriers have not wanted to pay the going rate for drivers that are fully documented, fully English speaking, sort of experienced drivers. That's going to be the biggest cost that the trucking company incurs on its P&L. It's going to be sort of that and fuel. And what's interesting about this, and it's kind of a nuance, is that some states have accepted foreign commercial driver's licenses, and they've sort of accepted those, even though they have not, the driver has not passed a domestic commercial driver's license examination. And so that was something that kind of some states are doing, some states haven't done. It tends to be more the bluer states have been the ones accepting the foreign CDLs. In 2016, the DOT officials were reportedly instructed to overlook drivers' CDL qualifications and work permits to accommodate those who don't speak English. And so it's essentially we're having a reversal of that instruction. And there was a good article that our CEO, Craig Fuller, directed everyone to read on Overdrive, and would highlight that one as well, written about a month ago. But essentially what Overdrive did is they looked into this. There's the headline there, April 30th. And Overdrive was trying to figure out just how much of an impact this is going to have. And so they contacted some of the national organizations like the Federal Motor Carrier Safety Administration, the FMCSA, to ask how many non-domiciled CDL holders there were and like what percentage it was. And that organization and the other national ones just didn't know. So they went then to the state level, started calling states, and they did get some information that was interesting. Kind of in Illinois, which is one of the states that was accepting the non-domiciled CDLs. It went from almost none of the CDLs that were newly issued were non-domiciled in 2015 to about 40% in 2025. Last year was about 18%. So it is pretty substantial. It kind of rose more or less linearly in the past 10 years. And then in Texas, went from about 1.5% in 2015 to about 2.8% last year. So not as nearly significant. And then Washington State, kind of in the middle, where it went from about 4% in 2020 to 16% in 2024. And so you sort of take this together and say, well, this could have pretty significant impact on trucker availability and capacity if trucking companies basically either police it themselves or the drivers decide not to drive if they don't have the proper documentation or are just stopped and deported. So that could have been related to why we saw maybe a greater than normal spike in spot rates related to the road check week, last week. But that's something to keep an eye on. Another thing to keep an eye on is the ocean market, and the ocean market has more or less gone through a V-shaped recovery. If you want to bring up the ocean bookings volume index. So this is one of the charts that is found in the Sonar Container Atlas app. We look at this a number of different ways. One of them is the booking volume index based on the date of departure. This particular one is the ocean booking volume index, data based on the date that bookings were submitted to the ocean carrier, which has a lead time from when the vessels are departed by about 16 days. That's something that's increased the last few weeks. Normally about 11 or 12-day lead time is increased to about 16. It is based on a 7-day moving average. And you very much see kind of the taco trade, the Trump always chickens out trade. So that big dip on the left part of the screen there is Chinese New Year. That's sort of normal. Was expected. Sort of before that was at an elevated level with pull forward for tariffs. Even think there was some pull forward right after the Chinese New Year. And should mention this is just from China to United States. Bookings that go through a clearinghouse, and then you see this drop off right after Liberation Day. Sort of went straight down and looked very much similar to what you would expect at sort of a Chinese New Year, although it took place maybe a little bit more gradually. But then you've seen spike upward after the 90-day delay in tariffs was announced to levels that kind of suggest essentially that there's another pre-buy. So we've gone from pre-buy to not having a lot of bookings, basically the bookings index going from about 100 to about 50 for a period of time. Now it's back up to about 120. And then in the latest data point, it's settling in at about 100. And so a lot of volatility there. It's also really interesting that the booking lead times increased from about 12 days to about 16 days, has since settled in about 13 or 14 days. And then there's also data in Container Atlas illustrating just how long it takes from not just the gap between the bookings, data of vessel departure, but just how long the vessels take on the ocean from China to the U.S. West Coast takes about 17 days. And then there's also, when you look at Project 44's data that's in Container Atlas, there's typically 1 to 3 days of delay on average. And then when you look at something from China to the U.S. East Coast, just looking at Savannah, that's more like 37 days instead of 17. And so that's why even up until last week or so, we're really seeing strong volumes coming in through the port of Savannah and the other East Coast ports. It was sort of this the final impact of the shipments ahead of Liberation Day, and so you would expect those ports to be relatively quiet for the next several weeks, and maybe the ports on the West Coast to be quiet for just the next few weeks before they pick up more substantially. There's a really good article on FreightWaves.com I want to highlight that was written by Stuart Charles, who follows the ocean industry extremely closely, also follows the railroads extremely closely. And he did an interview with individual at BNSF Railroad, John Gabriel. He's the vice president of consumer products, so I believe Rail Intermodal would fall under consumer products. And so BNSF is going to have an extra 100 locomotives ready to handle a container surge. So they are very much expecting containers to surge. And some of the data that they're highlighting is this V-shaped bookings from Asia, very similar to what I was just showing. They said they have line of sight on those shipments. So that sounds like very much what they're expecting from their discussions with ocean carriers. And they say it's probably about 3 to 4 weeks from now is when they think things will start to pick up. With the delay from when that article was published, maybe it's about 3 weeks now. And so I think that's going to translate into strong international intermodal and potentially even domestic intermodal volume, because there is some transloading that takes place on the West Coast. And so BNSF is expecting that the post 4th of July, things to get busy, and thinks we're in for another pull forward of ocean freight ahead of the August 12th deadline. We don't know what's going to happen after August 12th. If I had to guess, I would sort of think the 30% tariff that we have on China now is probably going to be roughly, what you would expect. So they're have 100 locomotives they're pulling into a surge fleet just in California alone. And so would expect a pickup first in the international intermodal outbound of LA. Have a sonar chart that shows what international intermodal has done. And it's really been at an elevated level. See 2025 is in white. You see it's dropped off the last few weeks. So that's the impact after, Liberation Day. You sort of think, well, Liberation Day was right at the beginning of April. This is a 7-day moving average. Then you have the 2 weeks, a little bit of time between the bookings and departure date. You have the 2 weeks between China and the U.S. normally. And so that's why you see that big drop off right at the end of April into May. The air pocket, as many people are calling it, but we expect this to start to surge again in the last few weeks. And it is also worth mentioning that really this international intermodal volume outbound of LA has been at an elevated level really throughout last year. That pink line in 2023 was a little bit more of a normal year, and it was extremely strong last year. You see 2024 in green, particularly the second half of last year. Some of that was pulled forward ahead of tariffs. Some of that was just related to strong service levels and rail intermodal just being very competitive versus truckload. And then you see 2025 at even higher level than 2024. So would expect it to come back and maybe look at least somewhat similar to what we saw in 2024 in the back half of the year. BNSF says that its railway is running the best it has since 2020, when volumes were depressed during the pandemic. That was a very easy time to operate the railroad because of the lack of volume in 2020. And they pointed to just a tremendous volume of investment that's taken place especially in a lot of those transcontinental lanes, uh, outbound from LA, and then also in a lot of terminals throughout the network that are big intermodal hubs. So, with that, that's really what I wanted to go over today. I would encourage you to sign up for the Stockout newsletter. I'll try to put in a little bit more directly related to CPG and retail, but lots happening in the freight market. So we'll keep you updated on that, and hope everyone has a good day.